Hello and welcome to the latest episode of On the Money, a weekly show that aims to help you make the most out of your savings and investments. So in this episode, we're going to focus on one of the hottest investment areas of 2025, which is commodities. We've seen the price of various commodities perform very well this year, and in particular, gold has soared. But in fact, that bull run for gold has actually taken place over the past 2 years, in which the gold price has doubled from $2,000 per ounce to around $4,000 per ounce. In this episode, we're going to mainly focus on gold and also the outlook for gold, but we'll also examine other commodities as well. Joining me to discuss this topic is Olivia Markham, who is co-fund manager of BlackRock World Mining Trust. So, Olivia, I want to start off with the gold price. So it's risen substantially this year, so far in 2025, but that bull run actually started around 18 months or 2 years ago. Now, there's been various reasons attributed to why the gold price has been shining, including geopolitical tensions, the weakness in the US dollar. For you, what are the main reasons behind this bull run for gold?
As you say, there's been a number of factors. But if I was trying to kind of boil it down to one, I think it comes back to the currency aversion trade and that concern that people have around, risk of traditional fiat currencies. We've seen increasing fiscal deficits, particularly in the US. We've had concerns around maybe where inflation goes to longer term. You pointed to geopolitical risk. We see central bank buying. And when that all kind of boils down, I think it's, what is that true safe haven investment now? And I think many people are going back to gold as that, given that some of the pressures on some of those other more traditional safe havens, be it the dollar, being US treasuries. And I think that kind of has really been kind of when you pull all that together, it's resulted in quite an incredible market for gold this year.
You mentioned central bank buying. That really has been a key driver. And is that because central banks are diversifying a bit away from the US dollar and then they're increasing exposure to gold?
So I think we also really need to remember that decisions made by central banks are very long-term decisions. And we saw a change in the behavior of central banks about 3 years ago. We've effectively seen central banks double their exposure to gold within their foreign reserves. So I think part of it is around diversification. It's thinking back to those comments around what is that true long-term safe haven investment. And we continue to see central banks globally increase the reserves of gold.
Now, while I know that you don't have a crystal ball and it is impossible to predict the future direction of any asset, stock market, etc., I did want to ask, what are your thoughts? I mean, gold has had this really strong run over the past 2 years. I saw in a recent investment commentary, you pointed out that gold is, at the moment, it's still unloved among generalists. Could you explain what you mean by that?
Yeah, so I think there's two ways we can think about this. So first, if you look at gold, we have seen more recently a pickup in gold ETF. So ETFs physically backed by gold purchases, but it still is below the peaks that we saw a few years ago. And it's been quite recent that we've seen buying come through there. If you look at gold equities, we actually still have outflows from the main big, large gold equity funds year to date. So I think that is certainly an area that is people are sort of noted underweight relative to historical allocations. So, for us, when we think there's no real point here where we are concerned about positioning in either gold or the gold equities. I still think this is a relatively niche area of the market. It's only really those specialist investors that are looking at this area, and relative to people that are running much bigger global funds or macro funds, this is still a relatively small allocation in their portfolios.
We've seen quite a notable increase over the past couple of months in customers within Interactive Investor buying exchange-traded commodities, in particular for gold and for silver. In terms of when gold becomes overvalued and potentially is a bubble, is this when there's a lot of demand from retail investors for gold?
I mean, when we think about whether or not a commodity looks extended, naturally we'll think about what have been flows into some of those gold ETF products, what has been positioning in the futures market, where are the valuations, for example, on some of the equities. And for us, none of those things are flashing particularly red. I don't like to use the word bubble too often, but we have had a pretty significant move up in gold, but it's not the moves that we've seen or the positioning that we've seen is not causing us any concern yet.
And could you talk us through how you invest in gold within BlackRock World Mining Trust? How much exposure do you have? And could you talk through how you invest in gold, which is through gold mining companies?
Yeah, so you're absolutely right. So we invest in the gold companies, the gold equities themselves, and we believe that is the best way to get exposure to gold, because if you have a look over time, gold equities typically perform through the equity risk premium, through the optionality they have to gold prices, through their ability to grow reserves and resources. So if you have a look at the BlackRock World Mining Trust, we have actually our highest allocation to gold equities and precious metals that we've I want to say ever had, but right up there, certainly over the last 20 years, and that's around about 40% of the fund today, and it's moved a lot. If I wind the clock back to 2022, 2023, we had less than 15% allocation to gold. So it's been a very deliberate move on our part. And I think something that's really important is when you think about how you get exposure to gold, is you're buying a gold equity or a gold company because you want to get leverage to the move in the gold price. And over the last couple of years, actually the gold equities have been quite disappointing. They just haven't given you an outsized return to the gold price. And that's because costs ate away at their margins, and they really weren't able to convert higher gold prices into higher earnings and free cash flow and dividends. It's been very different over the last sort of 12 to 18 months. We've been in this sort of Goldilocks environment of relatively modest cost inflation versus where we'd been over the peak of COVID. The companies are being disciplined, and the gold companies are doing a great job of capturing high gold prices, turning it into higher cash flow and stepping up dividends. And that's why these gold companies are giving you that kind of 2-to-1 ratio in terms of their performance relative to the move in the underlying gold price.
I touched on earlier that some of our customers have been buying silver ETCs. I know it's a very small part of BlackRock World Mining. Could you explain why?
Yeah, so actually, if you look at our gold companies, quite a lot of our gold companies have silver exposure as well. So there's, in terms of pure play silver, it's smaller, but it's actually really wrapped up into the rest of our gold companies. Silver's been a remarkable market. It's often thought of being a beta to the gold price, but it also has this really interesting industrial use, very closely linked to solar. And if you have a look at the build out in solar, particularly in China, the industrial pull on the metal has been very strong as well. So we do have some silver exposure in there. More recently, we've bought actually a early stage exploration pure play silver company in the US, which looks really interesting. We've also had a silver company acquired from us as well. So there's been a bit of movement. But for us, there is some interesting opportunities. They're just a bit more on the smaller cap spectrum.
And while both gold and silver have been taking up a lot of the limelight, there have been other areas of commodities that perform very well in 2025, in particular copper. Could you talk us through your exposure to copper?
Yeah, I think it is also worth mentioning because gold has obviously performed incredibly well, but actually the rest of the commodity complex has performed very well as well. So you referenced there copper. Copper's up 25% year to date. The platinum group metals are up over 70% year to date. There's some really interesting areas in our market right now, which I don't actually think has been kind of probably properly understood given this overwhelming market focus on AI. But if we go to copper, and copper is an area in the portfolio where we actually have a lot of active risk. We have a big copper bet in the fund today, and that's predicated on 2 points. So from a demand perspective, copper is the metal which is the backbone of electrification. It is key for renewable infrastructure, building up the grids, distribution of electricity. So that's really interesting. And you put alongside that, the power requirements that we are going to need for AI, the infrastructure spend that's going on globally, reindustrialization of major economies like the US, it all becomes very copper intensive. So I think the demand picture for copper looks really interesting over kind of the next decade or so. And then right now on the supply side, there has never been a point in time that I have seen more disruption in the copper industry from a supply side. We have 3 of the world's largest copper mines currently suspended. That puts incredible stress on a system that is already very tight. So we think that, the copper market looks interesting, not just now, but as we look longer term, because we are in an environment where we're going to have to bring on more copper supply if we want, electrification, if we want, the low carbon transition. And in order to do that, we're going to have to incentivize high cost assets into the market, and that means a higher copper price going forward.
And could you talk through how often you make changes to the portfolio and what your most recent changes have been, perhaps over the past couple of months?
So, in terms of our investment horizon, I think the best opportunities to generate alpha and outperformance is kind of when you look beyond 3 years. So, we do invest not necessarily on a quarterly earnings change, but where we think a company could be in the future. In saying that, we probably turn the portfolio over 30 to 40% or so during the year. So it's not a huge number, but we're certainly kind of pretty active. And particularly when you have some big moves, you need to be quite careful around how you manage positions, etc. In terms of recent changes that we've made, I think a kind of it's been further back, but we made a very deliberate decision at the sort of this time last year to increase our gold exposure. We saw gold as a really good way to play the uncertainty that was coming in terms of tariff announcements coming out of the US, and it's kind of been the correct decision. More recently, there's some really interesting dynamics that are happening in terms of, for example, the European steel industry with protectionist movements going on. That big shock that I talked about to copper, that's been very positive for a lot of the other copper companies out there. There's a big kind of focus at the moment around securing critical minerals outside of China. We've been playing that theme as well. So there's lots of micro themes that are always running underneath in the portfolio that we're trying to capture too.
You run a diversified portfolio investing in various different commodities. What are your thoughts on investors that decide to go down one route and to gain exposure to a particular spot price through an exchange traded commodity?
Yeah, so that is, I guess when you think about I want to have exposure to commodities or natural resources, you can do that through commodities themselves, or you can do it through the commodity equities. I touched on this earlier, but if you have a look over time, it's been the correct decision to invest in the commodity equities because they've given you that equity risk premium, they give you that optionality, that leverage to the move in the commodity price. The time that it doesn't work is an environment where you have cost inflation, which eats away at the producer margins. You see a lot of capital cost inflation. That's also a difficult environment. Or you see bad behavior by the companies and kind of value destructive behavior, and that has definitely been the case in our sector. We've had some fairly, we've got a poor track record of large scale M&A in the last cycle, so that can have that kind of value destructive behavior. I think for the right here and now, I think that we are in this environment where commodity markets are becoming increasingly tight. That puts upward pressure. The companies are being well behaved. They're trading, the companies themselves are trading at a discount to their historical valuations. So I'm very much in support of investing in the commodity equities versus the commodities themselves. And just to test me on that, we can invest in the commodities and we choose not to. We are choosing to invest in the equities directly.
And how often do you meet management teams? And do you meet management teams in person? And do you have on-site visits?
I meet so many management teams. It's the main thing we do in our job. I love doing it. We have hundreds of meetings per year. That can be in the office, that can be conferences. We've also got this great opportunity to get our hard hats on and go out and see the assets. So it's a big part of what we do. And I think it gives us actually our edge, particularly in a fund like the BlackRock World Mining Trust, which is a closed-end vehicle where we can buy into these earlier stage companies, work with the companies, nurture them, see them grow, and watch that value kind of grow alongside that with the share price. So big part of the job. And I think it is really important that we have a team that is well-resourced with technical expertise so that when we do go out and see the assets, we go in there with an educated view, and it helps us not only understand the opportunities, but also the risks that come. And that's a big part of our job too, is trying to avoid some of those pitfalls that can come in kind of investing in this sector.
I finally wanted to ask about the outlook for dividends. So BlackRock World Mining aims to deliver both capital growth, but it can also pay an income as well, although I know it's not a progressive dividend policy. And last year, there was a reduction in the income that was paid out to shareholders. So what's the outlook now for BlackRock World Mining's dividend?
Mm-hmm. So I think it's just, you kind of outlined our dividend policy there somewhat. So, I mean, we effectively pay out all of the income that we generate from the underlying holdings in the portfolio, and also some of the other things that we do around option writing. We can invest in mining debt securities, etc. So when you think about the outlook, it fundamentally depends on the outlook for dividends from our sector. We went through this period around COVID and just after of exceptionally high commodity prices, particularly in the bulk commodities like iron ore, and that resulted in very, very high dividend payments from the sector. Commodity prices have moved off those highs, and naturally our dividend has come down with that. As I look forward, what we're seeing is that gold companies are increasing their dividends, starting from a small base, but they're increasing their dividends. We have companies that have got strong balance sheets, so they have got scope to pay a fully covered dividend, and they do pay fully covered dividends. Capital spending has increased a bit, but still quite modest. So, I think we're still in a very healthy environment for dividends as I look forward. The absolute direction, honestly, will be dictated a lot by what the commodity prices do. But for us in the World Mining Trust, and I think this is really important versus, investors out there that might just want to invest in a single name mining company themselves, is, our aim really is to try and generate a dividend which is more stable, more defensive, more diversified than what's out there from just a single company or just a single sector themselves, because we can use all these other tools. We've got the option writing, we've got the ability to invest in privates, we've got some royalty investments of our own, we've got the mining debt securities and the equities on top, and the dividends from the equities on top. So, our dividend is much more diversified, and that's why you saw when there was a big dividend cuts at the bottom of the cycle of 2016, our dividend was much more defensive. We obviously had to cut, but it held up a lot better than the single name companies did. So I think that as we look forward, that's our aim. We want to have a very competitive dividend that's well underpinned and diversified.
Olivia, thank you for your time. So that's it for our latest episode of On the Money. If you enjoyed it, please do follow the show in your preferred podcast app, and please do leave us a rating or a review. Those ratings and reviews really help to improve the visibility of the podcast and to get it into more ears. We'd love to hear from listeners. You can get in touch by emailing otm@ii.co.uk. And in the meantime, you can find more insights and practical pointers on the Interactive Investor website, which is ii.co.uk. And I'll see you next week.